Companies and financial services organizations may be required to move their environmental, social, and governance activities under the supervision of risk and compliance teams due to new regulatory rulemaking concerning transparency. The environmental, social, and governance (ESG) disclosure standards were introduced by the Securities and Exchange Commission (SEC) in March 2017. These standards apply to public firms. Public firms must strengthen and standardize climate-related disclosures following these new requirements. Disclosures about additional climate risks, such as the impact of extreme weather events and the governance of risk management mechanisms, must also be provided. Welcome to Crypto News. Today, we will discuss what are ESG regulations and how they will affect you. Stay with us until the end of the video to learn more. Like and subscribe to this channel and hit the bell button to get notified of all the latest updates. Let's jump to the topic. Given the current set of regulations, it is abundantly clear that environmental, social, and governance (ESG) issues are moving from a primarily voluntary disclosure-oriented dimension to a regulatory one, which has significant implications for how ESG information is collected, verified, and acted upon within an organization. Even though these regulations are not yet clearly defined, it is abundantly clear that these changes are occurring. In recent years, a number of different frameworks have been developed in order to create standardization in the reporting of ESG data. These frameworks' aims frequently overlap with one another. For instance, the recently established International Sustainability Standards Board aims to develop requirements for various types of investors. Before that, the leading framework and standard-setting organizations, such as the Carbon Disclosure Project, the Climate Disclosure Standard Board, the Global Reporting Initiative, GRI, and the Value Reporting Foundation, itself formed by the integration of the Sustainability Accounting Standards Board, SASB, and the International Integrated Reporting Council, provided guidance and rules to develop a comprehensive corporate reporting system with both financial accounting and a focus on environmental and social responsibility. A combination of two or more frameworks described above is a strategy that major companies frequently implement. Companies such as Coca-Cola and 3M employ the Global Reporting Initiative, GRI, the Task Force on Financial Disclosures, and the United Nations Sustainability Goals as reporting and guiding frameworks. When, rather than being a voluntary necessity, however, information collecting becomes part of a compulsory requirement, a number of different issues come into play. The majority of the time, the task of data gathering falls within the purview of sustainability officers. These individuals are tasked with developing and enforcing environmentally conscious policies that are sustainable for their organizations. These experts are in charge of managing a company's influence on the environment and its resources associated with the environment. For instance, if a firm decided to install solar panels on the rooftops of their factories or purchase energy from wind farms, those decisions would be included as part of the recommendations made by the sustainability officer regarding the strategy for the company's energy mix. In addition, it will be the responsibility of the sustainability officers to constantly communicate these strategies to the market, often taking the place of executives who are responsible for public relations or investor relations. But, once this information is mandated by law, the duties that come with it will most certainly shift. Instead of being considered as just an agent of change and a communicator, sustainability officers will likely be tasked with increased delivery of data and strategic responsibilities in their new roles. Olivia Whitman, the head of sustainability at Siemens, stated, "Sustainability is becoming a delivery position. We've spent the better part of a decade attempting to be changemakers, and all of a sudden, we're being forced to establish processes and think about strategy." The recent announcement made by the SEC about the mandatory reporting of Scope 1 and Scope 2 GHG emissions is not the only illustration of the risk and compliance relevance of ESG data. Other occurrences also play a role in the transition of ESG into a compliance-related subject, particularly in the category known as S, which stands for social. The Uyghur Forced Labor Prevention Act is perhaps the piece of legislation that will have the greatest influence on the compliance relevance of ESG. This rule has resulted in additional stress being placed on supply chains worldwide since it makes it illegal to bring goods into the United States that were manufactured in the Xinjiang area utilizing forced labor, and it prohibits such imports. In the social category, the issue of forced labor can be addressed by firms' disclosures if a prohibition of forced labor applies to their supplier chains. This can be done under the heading of social. Compliance with legal standards should not cause structural changes to a firm's economic activities or supply chains if the company follows through on its environmental, social, and governance (ESG) objectives. For instance, certain provisions of the Lacey Act in the United States, which prohibits the illegal taking, possession, transportation, or sale of fish, wildlife, or plants, including lumber, include ESG-related laws. This act was designed in order to combat illegal trafficking. Not only are these measures discussed in social and governance disclosures, but they are also included in the regulations governing anti-money laundering in the United States. Why a strategy based on ticking off ESG boxes is not sufficient. Suppose environmental, social, and governance standards were determined entirely by the criteria of regulatory agencies. In that case, one might argue that complying with such standards would be as easy as ticking off a few boxes. Companies that responded in such a manner would, of course, comply with the regulations, but they would fail to recognize the overall strategic implications relating to ESG. First, environmental, social, and governance (ESG) data should be factored into formulating a risk-based strategy, which should finally find a place in the business risk assessments carried out by the Chief Financial Officer or the top risk management officer. In order to accomplish this, it is necessary to use ESG data in conjunction with third-party risk data, such as information on publicly exposed persons, sanctions, or corrupt actors. Second, in order to develop an effective environmental, social, and governance (ESG) strategy that goes beyond mere compliance, it is necessary to incorporate relative ESG performance into long-term business plans while maintaining a crystal clear understanding of the associated risks and opportunities. This is especially true in a sector that is undergoing a transformation as a result of environmental and social considerations, as well as a geopolitical climate that is continuously moving. If a business approaches ESG with a mentality of compliance or a box-checking approach, it runs the danger of falling short of the expectations of its investors and consumers and even of being unprepared for potential risks in the future. From the standpoint of reporting, environmental, social, and governance (ESG) reporting will be included in any new data reporting requirement that is analogous to SEC reporting, related legislation such as the 𝗖𝗵𝗶𝗍𝗄 Act or statutory reporting, amongst other requirements. In addition, it is necessary to make these reporting requirements accessible in order to fulfill the criteria of audit management. The development of an efficient ESG data approach. 57% of respondents in a recent survey by Deloitte of 300 finance, accounting, sustainability, and legal executives at public companies with more than $500 million in revenue indicated that data availability, access, and data quality, accuracy or completeness, remain their greatest challenges with respect to ESG data for disclosure. The survey was conducted with executives at public companies with more than $500 million in revenue. In order for enterprises to enhance data access as well as quality, they need to create and put into action an efficient data gathering strategy that incorporates both internal company disclosures and external data sources. A plan like this would consist of the following four critical elements: the gathering of environmental, social, and governance (ESG) data, the standardization and management of such data, in accordance with a variety of ESG frameworks, the distribution of ESG data to the appropriate decision-makers, including auditors, and the analysis and incorporation of ESG data into the organization's risk and strategic decision-making process. Not all of the information that has been gathered is required by law at this time. For instance, energy efficiency indicators and improvements are included in a variety of reporting systems. Nevertheless, their inclusion is not yet required by law. Companies that are looking to the future need to regularly evaluate the environmental, social, and governance (ESG) risks they face by merging the information obtained internally with data from external sources. Because the implementation of a risk-based approach that takes into account ESG data is going to become the norm, regardless of whether firms and their advisors are ready for it or not. If you made it to the end of this video and are interested in knowing more, in the comments section below, let us know which part of the video you liked the most. We will appreciate your comment and work to make a video on your desired topic with an account shout-out. Please like and subscribe to Crypto News and hit the bell button to be notified of our next video. Thanks for watching.